Welcome to the J Rise initiative of Christu Jayanti deemed to be University Bangalore. My name is Akhil. Today, let's discuss about Introduction to Financial Crimes, which is a part of Unit 3 of the course Economic Offences. As we move towards economic offences, let's understand a technique of detecting financial and economic frauds, which is forensic accounting. So let's have a quick look into the aspect of forensic accounting. Forensic accounting is a multidisciplinary activity combining accounting, auditing, investigation, and law. So this includes all these parameters, all these areas, and we try to deal with financial crimes. So what do they do as a forensic accountant? What is the job of a forensic accountant? They gather evidence for court, address the agency cost, they monitor fraud in complex financial transactions, in complex financial cases. So these are some of the functions of forensic accounting. Now let's look into the nature and scope and reach of forensic accounting and such sort of investigations. So as per the report to the nations 2020 by the United Nations, around 2,504 cases across 125 countries, which makes a financial loss of about $3.6 billion. So it's a huge amount. Financial frauds are accountable for losing billions of dollars every single year. A typical financial fraud lasts about 14 months, costing about $8,300 per month. So financial frauds, unlike many other crimes, is a very long process. Say a murder happens or a robbery happens. This happens in few minutes to few days, whereas financial fraud is a long process in which a lot of planning, execution, a lot of hiding the evidence, all these things are involved. So together they takes over an year of period where in a company or in an organization financial frauds are keep happening. So it's an ongoing process, whereas where companies lose billions of dollars every year, and many organizations loses as high as 5% of their annual revenue to frauds. So 5% is a huge number for especially in those industries where the profit margin is very thin. 5% loss can create a life or death situation for organizations and companies. In such scenarios, financial frauds can actually or can literally kill a company. Now, what are the different types of frauds that are happening, or what about the statistics of these crimes? So let's look at the data from US, because Indian data is not so much available in public. They are limited. But when we look at the data from US, the most common financial fraud is asset misappropriation. About 86% of the crimes comes under this category, where companies, organizations, institutions, NGOs, they all either show their assets valuation higher or lower according to the demand. Say if the organization need to get a bank loan, they will show their asset valuation higher so that they get better loans at a better rate or more amount, etc. Whereas they want to escape some sort of tax or some sort of fine or some such aspects, they reduce their asset value in order to hide actual valuation. So this amounts about 86% of the total crimes that happens in US. This data is from US, and the most costly one, costly as in the financial loss happens, is the statement frauds. Companies often misappropriate their financial statements. This could be for reducing tax. Companies might show their income or expense or mainly income or profit as low, or in some cases where a company want a loan or company is going for IPO, or they want to attract fresh investment. In such scenarios, they might show their financial statements, their income, their profit higher. So can be this crime happens about 10% of the cases, but it can be the most costly one where the investors or the tax collectors, as in governments, they all lose a lot of money because of this. Then 43 another interesting data is that 43% of the crimes are detected by tips given by employees and other stakeholders. So, and another interesting fact is about 72% of the financial crimes are done by men rather than women. Then for the financial crimes, the owners of the company face the maximum loss. It's not the public, it's not government, rather than the owners of the company themselves face a lot of loss due to financial statement misappropriations and financial crimes. So this is some data that obtained in the last few years from the US. So this clearly indicates how wide and how deep financial crimes are. Now let's look into the concept of fraud triangle. Uh, as forensic students, you all might have learned about crime triangle, which is common for almost all sort of crimes, where there is say a criminal, an interested criminal is there, there is a victim, and there is a situation. So these three makes the crime triangle. Similarly, we have something called fraud triangle, which is used to understand financial frauds. So fraud triangle, the very first thing is there is an incentive or pressure. That's a base point. So in order for someone to commit a crime, they either has to face a pressure or they have to get an incentive. So what sort of pressure? So the pressure could be to perform better, to show better results. The companies, the management, the owners, or the investors might pressure the employees to perform better, get better results, and sometimes their income or their job is at stake due to the poor performance of the company. So in such scenarios, due to the result of pressure, the CEO or the top management or the top executives, rather say, would resort to misappropriate the account statement, misappropriate the financial statements in order to show the company as more profitable or show that the company is earning more than the previous quarter, etc. Even in government sectors where the pressure to show performance can lead to these kind of financial crimes. Or on the other side, there is incentives. When somebody perform a crime, so they receives a huge financial incentive. Say in some cases, if the salary of the CEO or top executives are linked to the stock market performance, they manipulate the data in the company in such a way that the stock market prices skyrocket and they get good incentives. Or in cases of where they take commission from the vendors or commission from the suppliers. In such scenarios, this commission can act as a huge financial incentive for the executives. So incentives or pressure or both will act as the base of a financial crime. So then let's move to the next aspect, which is opportunity. So a company which is run with strict supervision, real complex organization structures, and is rigid control, it's very difficult to commit a financial crimes because every action taken by every employee from the lower layer to the highest level is accountable. So in such scenarios, it is very difficult for anyone to commit a crime, commit a financial crimes. Whereas in organizations where the control is limited or supervision is less, or the organization structure is very simple in startups and all, only few employees are there and one employee is responsible for almost all purchase related activities. In such scenarios where there is opportunity, people tend to commit more crimes, and that's obvious. The third is rationalization. Crime has, as we have discussed in every course of forensic science, crime got two aspects: the man aspect and the material aspect. So the human aspect of crime, which is the rationalization of crime or the psychology of the criminal, which speaks about the rationalization of financial crimes. In many cases, the person who commits financial fraud, we have seen it in the last slide that it takes 1 year or more to commit a financial crimes. How someone can stay motivated to commit a crime for such long period? What about their ethical values? So here comes the part of rationalization. When a person think of committing a crime, and or a person actually commits a financial crime, they rationalize their activity. They rationalize in such a way that they tell themselves that what I'm doing is right. I'm doing it because of these reasons. The management is pressurizing me, or they are underpaying me, or they behave rude or not really good proper with me. So they justify themselves for committing all these crimes. So these three together, if a person who's having incentive or pressure to commit a crime, and there is an opportunity, and the person is successful in rationalizing his activity, in a junction of these three, a financial crime happens. Now let's look into some of the major corporate frauds. If you are from India, if you are international. So in Indian case, the you might have heard about Satyam Computer scams or Kingfisher Airlines financial issues, Jet Airways issues, PNB fraud, ILFS fraud. All these are some of the classic case studies of financial crimes in India, out of which Satyam Computers were in around 2010, in around that period, 9, 10, that period. And Kingfisher, Jet Airways, PNB cases are little more recent ones. So in all these cases, some way or the other, the companies, what they did, they showed their financial, they manipulated their financial accounts and showed that companies are profitable when they were not. In Kingfisher case, it was for getting loans, whereas in Satyam Computers case, it was for getting better stock values. So in all these scenarios, in all these cases, the top management were involved. The as the owners or the CEOs or such high level directors or such high level people were involved in crimes. And in internet, when we move to the international case, the Enron case, uh, that's where the company want to raise, it was a startup, so the company want to raise a lot of funds, so they showed their performance of their, they were an electric truck manufacturing company. So they wanted to show their performance of their vehicle as superior to whatever available in the market to attract more investors fund. So in all these cases, one thing is quite interesting, that the top level, the crime is not done by a layman, crime is not done by an ordinary employee of the company. The major crimes are committed by the top level management themselves. So that's the another key feature of top corporate and financial frauds. It's done by people in position, it's done by people in power. So now the question is, what do we do? What are the job of forensic accounting people? So they perform bankruptcy and insolvency investigation. So what is wrong or what is special about this bankruptcy and insolvency? Well, it is a sad truth that a lot of businesses fail. When to start a business, the companies, institutions, organizations need capital. Quite often they approach the financial market, the capital market. It could be a bank loan, it could be some sort of say debt, or some sort of bonds. Either way, they raise a lot of funds and capital, and the companies try to run using that money, and many times they fail. So in such scenarios, a bankruptcy or insolvency become inevitable. And for every capitalist economy, it is quite common. It's nothing unusual or nothing rare or strange in a company going bankrupt. But the major problem happens when the bankruptcy or insolvency is fraudulent. When the organization has a lot of assets, the owners deviate it to their personal assets and show the company as bankruptcy. It is the fraudulent bankruptcy that we are investigating and finding out, or trying to recover the assets of the company. Then also the modern forensic accountants deal with computer forensic analysis, where a lot of data is not lots. Almost all the data are now processed using computers. So all the data misappropriations, all the information will be available in computers. So forensic accountants are now digging into the data available in Excel and other softwares and use that to come to conclusions. So now the third aspect is economic damage calculation. How much is the actual damage of a company due to a fraud? See, when 10 rupees lost, it's the damage is not limited to 10 rupees. The damage goes much beyond that. That's a damage of reputation. There's a damage of goodwill. There is a damage from the trust of the investors, market, and government and lenders. So the damage, actual damage of an economic offense is much deeper and much higher than the financial loss. Then in forensic accountants deals with family laws, asset tracing, when the wealth is has to be partitioned, or some cases the assets are hidden. So in such all scenarios, forensic accountant works. Then, as we have already discussed in fraud detection prevention, the forensic accountant works. Then another aspect is financial valuation. How much a company values. So many times valuation is an arbitrary number. The best example, the very recent example our students can correlate is the valuation of Byju's. So, couple of years back, especially during COVID period, this company, this EdTech was valuing at a massive $22 billion. Now the valuation is practically zero. So what happened from then and now? Well, the valuation, whether which valuation is right, whether the valuation of 22 billion was justifiable or the valuation of zero is something illogical. We don't know because nobody exactly knows what is the actual value of a company. So the idea of intrinsic value, the real value of an asset, is something a common collective consciousness rather than exact fixed number. So in such scenarios, the forensic accountants can help the people to come to a realistic valuation for a company by looking into the assets, the profitability, the growth potential, and on the financial statements, and etc. etc. So by looking into all these, forensic accountant along with many other people, financial accountants or corporate accountants, and so many other people are involved in valuation. Forensic accounting also plays a vital role in creating a fair valuation for business. Now let's look into the various types of frauds. The first category is a fraud in accounting cycle. In sales and collection, so there can be direct theft or skimming or lapping or unrecorded sales. So when you go to many places, many shops, jewelries, etc., not the top level jewelries, but the medium, small level jewelries, they might say, sir, if you don't want the bill, we will reduce the tax fee. So in those are examples of accounting cycle frauds where they don't record the sales at all. Some cases the purchase and payment in that area accounting cycles can happen. So shell companies can be involved or fake invoices can be made. Ghost employees can be another type of accounting fraud where a company shows a lot of expense by showing a lot of employees, but such employees do not exist. So these money will go to the pockets of the top officials, whereas to the government the company shows 100 employees, but actually there are only 10. Then the salary of the 90 employees was shown as the expense of company, and the management take money out of the company. Also showing false wages, reimbursement frauds. All these are other examples. Then inventory and reporting cycles. In such cases, how much inventory is remaining in the godown, how much is being dispatched, how much is there in store shelves, how much is actually been sold, how much inventory is available as a form of raw materials. So all these data the companies manipulate in order to show profitable, or in order to show to increase or decrease their income or profit according to the needs. So these are some of the crimes that are involved, that are commonly found in crimes in accounting cycle. So the next category is the reporting crimes. Uh, the these crimes exist in reports when they prepare, companies prepare all the financial statements like income statement, balance sheets preparation, all these statements. These crimes are happened in commonly. So the number one is overstating the revenues, understating liabilities. Many companies want to show them as rich and profitable, so they increase their revenue and reduce their liabilities in books. Actually, those things are there, but they show it a different rosy picture in the books. So then accelerated shipments, fictitious sales, and side agreements. All these are another methods report in books, whereas such sale has never happened. The company shows such a sale has happened. Then they again with inventory. So 10 is in the godown, they show it in 100 in books. Or improper capitalization, another example. Then uh, detection, cut-off testing, customer confirmations. So they project themselves as doing greater in business than they actually perform. This is the key of financial reporting crimes. Now it's time to move to some of the tools and techniques. So this lecture is gonna be an overview of how are we gonna what are we gonna learn and how are we gonna perform for the next couple of classes. So the IT tools for fraud detection are Helix. One is Helix, which is used to retrieve the hard drive as images. What is image? It's not the image as in photographs, whereas instead of copying the hard drive, we use it clone the hard drive in order to preserve the hash value of the data. So Helix is used. Then ACL desktop is a data analyst tool used by forensic accountants a lot. Then Ultra Block is used to prevent further data writing to the hardware. Then Password Kit for recovering passwords in password protected uh, hard drives and pen drives and other machines. So all these are some of the tools of. To conclude our lecture, let's glance through what we have learned. Accounting is a forensic accounting is critical for fraud detection, prevention, and legal evidence. And a multidisciplinary approach is needed to tackle financial crimes. And finally, constant evolution with the technology and complex fraud is present. So we must be well aware of the technologies used in financial frauds. That's it for the day. See you with another topic.